What does a failing Chinese economy mean for the US and the world at large? In the run-up to the Chinese Communist Party convention this year, troubles are coming to the Chinese economy not as single spies, but battalions. This must be of considerable concern for a vulnerable US and global economy. Until now, China has been the world's main engine of economic growth. It has also been the world's largest consumer of international commodities and a very large export market for the highly export-dependent German economy. One major source of the Chinese economy's recent troubles has been President Xi Jinping's zero-tolerance COVID policy. In an effort to eradicate the pandemic, Xi locked down major cities like Shanghai and Beijing. At times this involved more than 350 million workers unable to work normally. Little wonder then that the formerly fast-growing Chinese economy ground to a virtual halt. It managed to eke out only a 0.4% growth rate over the fiscal year that ended in July. There seems little prospect this damaging COVID policy will be reversed anytime soon. Seeking a third term as president at the forthcoming Communist Party convention, she can't afford to lose face by making a COVID policy U-turn. Yet this very likely will delay any Chinese economic rebound. With surging global economic crisis coupled with stagflation and inflation in so many countries, what would a failing economy of one of the giants like China mean for the whole world? We would dive into the details of this predicament in this video. Don't forget to leave your comments. Also hit the like button and subscribe. Serious signs of trouble are also resurfacing in China's all-important property sector. That sector accounts for almost 30% of the country's economy and almost 70% of household wealth. Already last year, 30 Chinese property developers, including most importantly Evergrande, began defaulting on their debt mountains. They did so against the backdrop of the government's effort to rein in credit expansion to put China's housing market on a more sustainable basis. They also did so at a time when the Chinese property bubble led to an estimated 65 million unoccupied housing units and credit expanding at a faster clip than that which preceded the US 2007 housing market bust. A sure sign that the Chinese property market bubble is now bursting is the steady decline in property prices over the past year. China's property crisis seems to be deepening as a growing number of households refuse to make mortgage payments on properties they bought but are yet to be completed. This mortgage boycott, which now involves around 1 million households, could cause China's property crisis to spread to the country's banking system. That, in turn, threatens to hobble the country's growth prospects by landing its banking system with a mountain of non-performing loans, much as occurred during Japan's lost economic decade. As if this were not sufficient reason for concern, China has been engaging in aggressive military exercises near Taiwan, perhaps to distract from its economic woes in the run-up to the convention. This is already discouraging foreign investment and raising questions about the wisdom of relying on China as a key part of the global supply chain and on Taiwan as an important supplier of electronic chips. There's never a good time for a slowdown in China, the world's second-largest economy. However, now seems a particularly bad time for the challenged economies of the United States and other nations. Economic powerhouse Germany, which is highly dependent on China for its exports, is already having to cope with large Russian energy supply cuts. At the same time, the heavily indebted emerging market economies, already on the cusp of default, can ill afford additional downward pressure on international commodity prices that a further slowing in the Chinese economy would entail. From a U.S. perspective, the grim Chinese outlook has to raise questions about the wisdom of the Federal Reserve's current hawkish monetary policy when the U.S. already appears to be on the cusp of a recession. Not only is China's slowing economy likely to continue relieving U.S. inflationary pressure by contributing to a further decline in international energy and food prices, it's also likely to restrict U.S. export prospects by contributing to a further slowing in the global economy. China is continuing to pursue a zero-COVID policy that has put major cities into full or partial lockdowns. In a statement after its quarterly economic meeting, the 25-member Politburo, which is chaired by President Xi Jinping, said leaders would strive to achieve the best results possible. However, it also called on stronger provinces to work to meet their growth targets. Analysts said the lack of a GDP mention was notable, though economists had earlier predicted it would be difficult for China to reach its 5.5% target. The 5.5% growth target is no longer a must for China, Iris Pang, chief China economist at ING Bank, had told news outlet The Wall Street Journal. They also added that China was urging larger provinces to make up for those that were more affected by the lockdown. Beijing requested that provinces which are relatively well-positioned should strive to achieve economic and social targets for this year, Nomura analysts Ting Lu, Jing Wang and Harrington Zhang said in a note. We think Beijing is suggesting that GDP growth targets for provinces with less favorable conditions, especially for those that were hard hit by the Omicron variant and lockdowns, could be more flexible. Earlier this month, China said its economy had contracted sharply in the second quarter of this year. Large Chinese cities, including the major financial and manufacturing hub of Shanghai, were put into full or partial lockdowns during this period. China's once booming property market is also in a deep slump, and home sales have fallen for 11 consecutive months. Several Chinese developers have halted the construction of homes that had already been sold because of concerns over cash flow. In recent weeks, some home buyers have threatened to stop paying their mortgages until the work restarts. In 2020, China made the rare decision to scrap its GDP targets in light of the pandemic. GDP measures the size of an economy. Gauging its expansion or contraction is one of the most important ways of measuring how well or badly an economy is performing and is closely watched by economists and central banks. It also helps businesses to judge when to expand and recruit more workers or invest less and cut their workforces. Beijing, China reported data for July that came in well below expectations. Retail sales grew by 2.7% in July from a year ago, the National Bureau of Statistics said Monday. That's well below the 5% growth forecast by a Reuters poll, and down from growth of 3.1% in June. Within retail sales, catering, furniture and construction-related categories saw declines. Sales of autos, one of the largest categories by value, rose by 9.7%. The gold, silver and jewelry categories saw sales rise the most, up by 22.1%. Industrial production rose by 3.8%, also missing expectations for 4.6% growth and a drop from the prior month's 3.9% increase. Fixed asset investment for the first 7 months of the year rose by 5.7% from a year ago, missing expectations for 6.2% growth. Investment into real estate fell at a faster pace in July than June, while investment into manufacturing slowed its pace of growth. Investment into infrastructure rose at a slightly faster pace in July than in June. Fixed asset investment data is only released on a year-to-date basis. The unemployment rate among China's youth, ages 16 to 24, was a high 19.9%. The unemployment rate across all ages and cities was 5.4%. The national economy maintained the momentum of recovery, the Statistics Bureau said in a statement. But it warned of rising stagflation risks globally and said the foundation for the recovery of the domestic economy is yet to be consolidated. The local situation reflects the large gap between goals set at the beginning of the year and the ensuing reality. Hainan had set a GDP target of 9%, but was only able to grow by 1.6% in the first 6 months. Similarly, at a national level, China's GDP grew by just 2.5% in the first half of the year, running well below the full-year target of around 5.5% set in March. China's top leaders indicated at a meeting in late July the country might miss its GDP goal for the year. The meeting did not signal any forthcoming large-scale stimulus, while noting the importance of stabilizing prices. With the zero-COVID policy in place, the chances of a rebound for the China economy anytime soon seems to only be a fool's dream as so many factors are affected by the policy. How the world reacts to this economy CRI.CIS is of major concern as it seems we are plunging deeper into a large-scale global economy storm as the days go by. Let us know what you think about China's role in global markets and what you think can be done. Leave your comments below. Don't forget to like and subscribe. Thanks for watching.